Okay, let's unpack this. American Resources Corporation, ticker AREC, around April 2025, it was trading near 61 cents.
Yeah, 61 cents. That kind of price definitely makes you look twice.
It does. But get this. The analyst consensus. A screaming, strong buy. Like, really strong.
And the price targets are way up there, right?
Yeah, around $4 on average. Think about that upside. 5, 6, maybe 700% potential.
Wow. Okay, but there's always a but, isn't there?
Always. Because on the flip side, you've got significant short interest. A lot of folks betting against the stock.
So you have this massive divide, analysts saying buy, 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 and shorters saying no way. That's high stakes.
Exactly. That's why we're doing this deep dive today. One of you sent in a bunch of research on ARC, and, well, our mission is to figure out what's really going on.
Right, cut through the noise. We've looked at research reports, news, financials, the whole shebang.
The whole shebang. Because just looking at the price or the analyst rating, clearly not enough here.
No way. When you see this kind of conflict, you have to dig into the fundamentals, the business, the money, the market vibes.
So to make sense of this AREC puzzle, we've structured our deep dive, 7 chapters.
Okay, what are we covering?
We'll hit the business itself, management, the financials. Brace yourselves for that one market sentiment, ownership, risks, and then wrap it up.
Sounds like a good roadmap. Get people the info they need.
Exactly. A shortcut to understanding what's driving this, volatility. Let's dive in.
Let's do it. So first question, what does AREC actually do? Because that price and those targets suggest something big is expected.
Right. Chapter 1, business understanding. And the big thing is they've pivoted hard.
Pivoted from what?
From metallurgical coal, mostly. That was their past now. They're calling themselves a next-generation environmentally and socially responsible supplier to the new infrastructure market.
Okay, buzzwords aside, what does that actually mean?
It means critical minerals and recycling. That's the new focus. RE's rare earth elements, critical battery minerals.
So moving away from coal's environmental baggage towards the electrification trend, basically.
Pretty much. They had met coal, PCI coal, but look at the recent revenue. Almost zero from coal.
Wow, okay. So the old business is essentially gone. Future depends entirely on these new ventures.
Exactly. Mining waste, recycling. That's where they see the new materials will come from.
That immediately flags it as higher risk, doesn't it? Transitioning like that.
Absolutely. And it's not simple. They operate through subsidiaries.
Ah, the complex structures. Let's break that down.
Key one, ReElement Technologies Corp. AREC owns about 19% of it.
And ReElement does?
Refining. REEs, lithium, cobalt, nickel battery stuff. They claim this proprietary chromatography process, supposedly cheaper, greener.
Chromatography, like a super precise filter for molecules, right? Separating the valuable stuff.
That's the idea. And they have facilities in Indiana. This seems to be where a lot of the bullish hope comes from.
Makes sense. Domestic, maybe cheaper, greener refining for critical minerals. That ticks a lot of boxes strategically. ARE's fate seems tied to this 19% stake then.
Heavily tied. Then there's Electrified Materials Corp., EMCO. AREC owns 100% of this one.
Okay, what's EMCO's role?
Pre-processing. They take old magnets, batteries, scrap metal, and get it ready for ReElement to refine.
So they feed the beast, basically.
Kind of. Now, EMCO had a bit of drama. They were supposed to go public via a SPAC merger with AITR.
Oh, yeah, I remember that. It fell through, didn't it?
It did, fell apart. And AREC publicly blamed AITR for it. Now they plan to just spin EMCO off directly with a Form 10 filing.
A failed SPAC isn't usually a great sign. Could mean execution problems, maybe due diligence issues, but they still think it's valuable enough to spin off.
Seems that way. Then quickly, there's American Infrastructure Corp., AIC. AREC kept about 9% after spinning it off.
And AIC is?
More traditional. Royalty streams for stuff like steel production materials. A link back to their older world.
Got it. Spinning that off suggests they're really trying to focus on the new critical minerals angle.
Yeah. And they have smaller stakes in things like Novusterra graphene from waste and Advanced Magnetic Lab permanent magnets. Lots of irons in the fire.
It's ambitious, covering a lot of ground, but also complex. Spreads resources thin, maybe?
Could be. And remember, AREC is small. Market cap floating around $40–60 million, these new ventures. Not large scale right now.
That size screams high risk, high reward, huge potential if it works, but very vulnerable if it doesn't.
So their pitch is, we supply materials for old infrastructure, steel declining, and new electrification, batteries, magnets growing. Plus, we're eco-friendly, using waste, and we're a domestic alternative.
That domestic angle is key, with all the focus on supply chain security. It's a good story, if they can deliver.
Which brings us to the key question for this chapter. Do you really get what AREC does now, and how they plan to actually make money going forward since the coal money is gone? Keep that in mind.
Absolutely critical question. The story needs to translate into actual, revenue and profit. Let's see if management inspires confidence.
Okay, Chapter 2, Management Evaluation. Who are these folks leading this major shift?
Yeah, the team steering the ship through these choppy waters. Their track record matters a lot.
All right, leadership. Mark Jensen, CEO, chairman, finance guy, commodities background, been there since '06, drove this pivot. Lots of deals in his history.
Okay, who else?
Tom Suave,
Yeah.
president, director, background in mining ops, restructuring. Kirk Taylor, CFO, CPA, focus on tax stuff. Tarlis Thompson, COO, handles the mining operation side.
And they claim, what, 100+ years combined experience?
Something like that. Sounds impressive on paper, right?
It does, but experience in what, and how has it worked out for this company? That's the real question.
So let's look at that track record. Jim's been active since '06.
Yeah.
Acquisitions, yeah, often distressed assets.
Yeah.
Led the pivot, the spin-offs, the failed SPAC.
So definitely busy. But what about the results?
That's the rub. Persistent financial losses, serious cash burn, high debt, and the stock price. Let's just say shareholder value hasn't exactly been created.
Oof, not a great scorecard despite all the activity.
Plus, they're non-compliant with NASDAQ listing rules right now. That's serious.
Very serious. Delisting risk is major.
And, maybe concerningly, both Jensen and Suave sold a decent chunk of their shares back in August 2023.
Insider selling, especially by the CEO and president. That never looks good. Sends a potentially negative signal about their own confidence, doesn't it?
It can, yeah. Now, when they've hit bumps, like potential debt defaults in 2022, they navigated through them somehow. They did the spin-offs. And the failed SPAC, they pointed the finger squarely at AITR.
How a company handles crises tells you a lot. Blaming the partner publicly.
Yeah.
Well, it's a choice. And the NASDAQ issue still hanging over them suggests ongoing problems.
Communication-wise, they're active. Press releases, IR calls, governance docs are out there.
But is the communication matching reality?
That's what feels off sometimes. You hear very optimistic talk, especially about ReElement's amazing potential. But then you look at the financials.
And they tell a different story.
A very different story. And the complex structure with all the subsidiaries, it kind of obscures things, makes it hard to see the real value or lack thereof.
That disconnect between optimistic talk and financial reality is a classic warning sign. Investors need to be wary of that. Complexity can definitely hide problems.
They do talk up the environmental and social responsibility angle, have ethics codes. We didn't find major scandals, though that SPAC breakup argument was, let's say, heated.
ESG talk is standard now. Needs real action behind it. The SPAC spat is maybe a minor point, but suggests potential friction in partnerships.
So the bottom line on management, are they honest, capable, shareholder-focused, given the losses, the debt, the NASDAQ problem, the failed SPAC, those insider sales? It's a tough call.
It really is. Honesty feels questionable with the communication gap. Capability is judged by results, which aren't there yet financially, and shareholder alignment. The track record in insider sales raise serious doubts. Caution seems warranted.
Okay, deep breaths, everyone. Chapter 3, Financial Health. Let's look at the numbers.
Right. This is where the rubber meets the road. Does the data support the story or expose the risks?
We pulled key metrics around mid-April 2025. Market cap, roughly $49 million. Share price, 61 cents. Well below NASDAQ's minimum.
Okay, small cap. Compliance issue noted. What about earnings?
PE ratio, negative, not meaningful, no profit.
No profits. Got it. Revenue.
Okay, get ready. Trailing 12 months revenue, about $2.4 million. 400,000.
Oh, 0.4 million. Didn't they do like $17 million the year before?
Yep. $17 million in FY23, down to $9.4 million TTM. It's a near total collapse. The coal business revenue is basically gone.
Wow, okay. That confirms the pivot wasn't just talk. The old business is done. Margins.
Gross, operating net, all negative or NA. They're losing money at every stage.
No surprise there with revenue that low. Balance sheet, debt versus equity.
Also grim. Debt to equity, negative or not meaningful.
Yeah.
Because their total debt, almost $218 million.
$218 million on a $49 million market cap.
Yep. And that debt is more than their total assets of around $212 million.
So, negative equity. Liabilities exceed assets.
Bingo. Negative shareholder equity. A massive red flag. Means if they liquidated, technically there'd be nothing left for shareholders after paying debts.
That's incredibly precarious. Free cash flow.
Negative, of course. They're burning cash, price to book. Also negative. Useless.
Okay, so summarizing the financials.
Yep.
Effectively zero revenue from the old business, no profits, huge debt load, negative equity, burning cash. It's dire.
Dire is the word. It really highlights how much those analyst targets seem based purely on future hope, not current reality.
Completely disconnected. It's valuing a potential future turnaround that has yet to show any financial traction. Classic story stock, ignoring fundamentals.
Digging slightly deeper on stability. Earnings consistency, no volatile losses recently. Dividends, never, no prospect.
Debt management.
Seems poor. $218 million debt, negative equity, past potential defaults. Looks unsustainable without more cash infusions. They've used convertible notes too, more debt essentially.
And cash on hand, working capital.
Very tight. Only $2.7 million cash end of 2023, was even lower before that. Liquidity is a massive constraint. Managing cash burn is critical for survival.
So low cash, high burn, massive debt, no profits, negative equity. It's a perfect storm of financial instability.
So the key question for this chapter: profitable, strong balance sheet, resounding NO, losses, negative equity, huge debt, highly unstable, totally dependent on outside help, or a miracle turnaround.
From a fundamental view, it's about as weak as it gets. Really concerning financial profile.
All right, let's pause for a quick word from our sponsor, stockanalytics.ai. Are you tired of sifting through endless financial reports and news articles? Do you wish you had a powerful AI assistant to help you make sense of the market? Then look no further than stockanalytics.ai. Our cutting-edge platform uses the latest in artificial intelligence to provide you with in-depth analysis, real-time data, and actionable insights on thousands of stocks. Whether you're a seasoned investor or just starting out, stockanalytics.ai can help you identify opportunities, manage risk, and make smarter investment decisions. Visit stockanalytics.ai today for a free trial and unlock the power of AI for your portfolio. That's stockanalytics.ai, your intelligent edge in the market. And we're back, diving deep into American Resources Corporation. We've covered the shaky business pivot, the questionable management track record, and those alarming financials. Now, Chapter 4, Market Sentiment. What does the wider market make of all this?
Yeah, given those fundamentals, how is the market actually pricing this? Sentiment can be a powerful, sometimes irrational force.
Well, the market seems to see it as highly speculative. Definitely a microcap gamble. You see it in the price volatility, that sub $1 share price, the high trading volume.
And the narrative seems heavily focused on real elements potential, right?
Totally. It feels like the whole bull case hangs on that one subsidiary hitting a home run.
Which is risky, pinning hopes on one specific outcome, especially when the current reality is so different.
Now here's where it gets wild again, those analyst price targets. We mentioned the strong buy consensus from a few smaller firms, ACW, Roth, EF Hutton.
And the average target is still around $4.
Still around $4. That implies what, 500, 700% upside? It's huge.
Yeah.
And they're all kind of clustered around that number, despite the financials we just discussed. They're even forecasting profits relatively soon.
That uniformity and optimism is striking. It suggests valuation models heavily weighted towards future projections, maybe downplaying the current massive risks and cash burn, almost requires an immediate dramatic turnaround.
Yeah, it's a big leap of faith, very typical of story stocks where the narrative outweighs the numbers for some.
What about news flow? How does that impact sentiment?
It's been mixed. Positive news pops the stock, short-term, re-element tech progress, maybe a contract, EMCO grants or JVs, spin-off updates.
That's the negatives weigh it down.
Yeah, the NASDAQ non-compliance news hurts. The failed SPAC didn't help. And those 2025 tariffs are a wild card bad for any remaining coal exposure, maybe good for domestic critical minerals. Uncertain.
So lots of news-driven volatility, adding to the speculative field, nothing providing clear, sustained direction.
And then the other side of sentiment, the short sellers. We said there's significant short interest.
Right, somewhere between, 4.5% and nearly 9% of the float? That's substantial.
Definitely. Plus, high off-exchange volume often linked to bearish activity. These shorts are clearly focused on the weak financials, the execution risk, cash burn, potential dilution from raising more money, and the delisting risk.
They're betting against the optimistic story, focusing on the tangible problems. We saw limited options data, but Citadel had puts and calls earlier in 25? Hedging bets, maybe?
Possibly. Or just market making. But the significant short interest is the main takeaway there.
So, overall sentiment. Extremely polarized.
Totally. Bullish analysts looking way ahead versus bearish shorts looking at the here and now. It's a battleground stock.
This division really highlights the uncertainty. Investors are making very different bets on a very unclear future.
Okay, let's shift gears to Chapter 5, ownership structure. Who actually owns AREC? Does that tell us anything?
Yeah, ownership can give clues about institutional confidence, insider alignment, or lack thereof.
Well, institutional ownership seems pretty low, maybe around 7.8%.
And who are those institutions? Active managers betting on the turnaround.
Not really. Mostly the big passive index funds, Vanguard, BlackRock, Geode, Schwab. They likely hold it just because it's in some small cap index.
So not necessarily a vote of confidence, just index inclusion. Low overall institutional conviction, then.
Seems that way. Now, insider holdings, the data's a bit messy. We saw ranges from 15% up to maybe 35%.
How does that break down?
Individuals insiders, think Jensen, Schwab, maybe around 15%. Then there's a corporations, private category, holding around 19%. Could be affiliated groups like Golden Property.
Okay, so potentially high insider ownership on paper,
But those significant stock sales by Jensen and Schwab in August 23, and apparently Golden Properties have been selling more recently too, that undermines the alignment argument a bit, doesn't it?
it certainly does. High ownership percentages don't mean much if the key insiders are actively selling sizable chunks. Raises serious questions about their long-term belief.
So ownership seems concentrated among insiders, affiliates, passive funds, and the public float. A lot of shares aren't freely traded day to day. Public float is around 51 million out of 77 million shares outstanding.
That concentration can add to volatility, fewer active traders determining the price.
And governance. They have the usual documents, but that NASDAQ non-compliance is a big governance failure, isn't it?
Absolutely. It's a fundamental requirement they're failing. Makes you question board effectiveness, especially given the poor performance, value destruction, the SPAC mess.
The board's overseeing spin-offs and investments, but the track record isn't great so far.
So the ownership picture reinforces the speculative feel. Little active institutional support concerning insider sales despite high reported stakes, and governance lapses. Not exactly a picture of stability. Doesn't build confidence. No, it aligns with the high-risk profile we're seeing elsewhere.
Okay, time to synthesize all this. Chapter 6, risk assessment using a SWOT analysis. Strengths, weaknesses, opportunities, threats.
Good framework to pull it all together. Let's start with strengths. What have they got going for them, potentially?
Okay, strengths. Potential access to unique feedstock via waste streams, their proprietary re-element tech, if it works, strategic market position in critical minerals, some existing infrastructure, and management does have financial deal-making experience.
Right, so potential cost advantages, a tech differentiator, playing in the right sandbox, some assets, and financial savvy. Plausible strengths. Now, weaknesses.
Oh boy. This list is longer. Extreme financial distress, debt, negative equity, losses, cash burn, low cash, unproven scalability of the tech, huge dependency on raising more capital, NASDAQ non-compliance, delisting risk, poor historical value creation, complex corporate structure, past execution failures like the SPAC.
That's a hefty list of weaknesses. Financial distress is probably number one, limiting everything else. Unproven tech and execution track record are major hurdles, too.
Definitely. Opportunities. What could go right?
Well, if re-elements tech is successfully commercialized at scale, that's huge. The recycling market for EMCO is growing fast. Favorable government policies for critical minerals could help, strategic partnerships, maybe licensing revenue, and a successful EMCO spinoff could unlock value.
So potential for a tech breakthrough, market tailwinds, policy support, and strategic moves. Plausible upsides. But then, threats.
Threats are significant, too. The technology could simply fail at scale or prove uneconomic. Funding risk, they might not be able to raise enough cash. NASDAQ delisting is a very real near-term threat.
Yeah.
Intense competition, especially from established players like China.
Right, and tariffs could backfire or cause broader economic issues. Commodity price swings are always a risk. Regulatory or permitting delays for new facilities. And a NASDAQ compliance deadline itself is a threat.
And underlining all that, the threat that management simply can't execute this incredibly difficult turnaround.
Exactly. So boiling it down to key risks. Financial viability is paramount, high chance of needing dilutive funding. Insolvency risk exists. Execution and technology, can they actually scale this profitably? Market risks, price volatility, tariffs. Regulatory and compliance, the delisting threat is immediate. Competitive landscape is tough. And management execution capability.
These risks are all tangled together, aren't they? Financial weakness makes execution harder, regulatory issues block progress. It's a very challenging situation. Highly speculative, substantial potential for loss.
Absolutely. The path forward looks incredibly narrow and full of obstacles. Okay, we're at Chapter 7, the conclusion and the end hook.
So wrapping this all up, what's the final picture?
Well, summing up the deep dive, AREC is in the middle of a massive, super high-stakes pivot, trying to leave declining coal behind for critical minerals and recycling.
But it all hinges on unproven tech, and they're doing it while facing, frankly, severe financial distress.
Right, and the market, totally split. Huge optimism from some analysts, deep skepticism from short sellers.
It's a bet on a future breakthrough against long odds, complicated by financial fragility and regulatory pressure. Massive potential upside, sure, but also a very real risk of failure.
So, here's the final thought, the provocative question for you listening. Given the extreme financial weakness, the dependence on future tech success that's far from guaranteed, does that current share price, around 60 cents, reflect an informed bet on that potential? Or is it maybe, just maybe, a case of hope triumphing over the hard, cold financial facts?
That's the multi-million-dollar question, isn't it? Is it a bargain entry point or a reflection of profound risk? Something every potential investor needs to grapple with.
So there you have it. Our deep dive, based on the sources you sent in, paints AREC as a very complex, high-risk situation.
Hopefully this detailed look gives you a better foundation than just headlines, helps you draw your own informed conclusions.
We'll keep doing these deep dives on topics you send us, so keep the research coming. All the sources are in the description.
Remember, digging deeper is key to navigating these complex market stories.
And hey, if you found this useful, please subscribe wherever you listen. It helps others find the show.
And definitely subscribe to the Stock Analytics AI YT channel for more analysis.
Okay, last thing, the important disclaimer. This was for informational purposes only. It is not financial advice. Do your own thorough research before making any investment decisions. Past performance doesn't guarantee future results, and AI analysis is just one tool, not a crystal ball.